Okay, Kai, there's one major concern that many of our viewers have brought to our attention regarding hybrid pensions and annuities, and that is, what if the company goes bankrupt?
Well, I would say every customer has asked us that question, so let's find out.
Hi, I'm Ann,
And I'm Kai.
and welcome back to our channel, where our goal is to help you retire healthy and wealthy.
Now, this is going to be part of a new series called What the Fact.
Well, that didn't sound quite right.
What?
To be clear, it's not what he made it sound like. It's What Are the Frequently Asked Questions series.
What the Fact?
Sure, you do you, honey. So, Kai, there's been many concerns, especially after what happened to the Silicon Valley Bank and how fast they got in trouble. So, the most asked question is, what if the insurance company goes belly up?
Well, let's first start comparing banks to insurance companies. One similarity between banks and insurance companies is that they are typically insured in the event of insolvency or bankruptcy.
That's true. The banks have the FDIC, and the insurance companies within each state have the State Guarantee Association. But people are still concerned that something could happen to the insurance companies overnight, like the Silicon Valley Bank.
Of course, that's a very valid concern. But remember, the biggest difference between banks and insurance companies is that banks have consumer checking and saving accounts. This allows the consumers to withdraw the money. Now, what would happen if most people withdrew the money all at once?
Well, that's exactly what happened with the Silicon Valley Bank.
Exactly.
Besides the lack of diversification, many local businesses that held large sums of money feared the solvency of the company, and therefore they pulled everything out.
Exactly. That is the key reason they fell.
It makes sense. But what about when the bonds and treasury values fell, when interest rates went up? Couldn't that happen to insurance companies too?
Yes, but insurance companies don't have a consumer checking and savings account. So consumers cannot just pull out all their money at the same time. Think about all of their premiums that people cannot pull out. You got the health insurance premiums, the life insurance premiums, traditional annuity premiums. The only monies that consumers can pull out are perhaps deferred annuities and some cash value life insurance policies. So since consumers cannot just pull out all their money out like the bank, this is a key factor that protects the insurance companies from a major collapse like the bank.
Another question we get a lot is the collapse of financial institutions and banks in 2008. According to CNN in 2008, 25 banks failed, according to the Federal Deposit Insurance Corporation's database. Included in that count is Washington Mutual, the largest bank failure in U.S. history. Over the 3 years that followed, nearly 400 banks failed. So for our viewers, Kai, how would you compare that collapse to an insurance company?
A good question. First, remember the institution's business model. For the most part, it boils down to investments or insurance. Now, when you invest with banks or many investors, their goal is to do what with your money?
Invest and loan it out.
Exactly. While the investment part is already at risk. However, loaning your money is a much higher risk. Don't you agree? What if the bank doesn't get the money back from their borrowers? Borrowers, can't say that word. But what if the borrowers don't have the money?
Well, that's why we saw the huge collapse in 2008. But don't insurance companies loan out their money too?
Yes, but remember the insurance company's business model. Is it to loan out your money like the banks? Or is it to collect premiums and to pay claims? When claims come in, they must have the reserve money there to pay those claims. That's why if you look at most insurance companies' financial portfolio, the majority is in bonds. And usually only 10 to 15% is in mortgage loans. But that's about it. The rest might be invested in some type of equities. Also, most of the insurance companies only have 1 to 2% real estate. Why? They need their money liquid to pay the insurance claims.
Okay, so insurance companies are less likely to become bankrupt because consumers cannot pull out their money all at one time.
That's right.
Insurance companies loan very little out. But you mentioned something about paying claims. What about a catastrophic natural disaster? This could make a company go bankrupt as well too, right?
Absolutely. But This is a risk for the car and home insurance world called property and casualty insurance. If you look at most of the insurance companies that went bankrupt in the past few decades, the majority is property and casualty insurance. Hybrid pensions and annuities are only sold through life and health insurance companies, not through car and home insurance world of the insurance companies. The only life insurance companies that went insolvent are the small companies, not the big ones in the recent years like Nationwide, North American, Athene, and so forth.
So if there's, say, a catastrophic earthquake or wildfire that could cause an insurance company to go bankrupt, you're saying that would not hurt hybrid pensions or annuities?
Exactly. See, the key to understanding hybrid pensions and annuities is to know that they are technically an upside down or a reverse life insurance policy. With life insurance, you pay the insurance company until you pass away, and then the insurance company pays your beneficiaries a lump sum. Hybrid pension and annuities are the opposite. You pay them a lump sum, and they keep paying you each year until you pass away. That's why hybrid pension annuities are only sold through life and health insurance division of the insurance company. But let's say an insurance company has both life and health as well as property and casualty license. It's a separate state license and division altogether. There's a separate reserve for each side of the business as well. Also, unlike a natural disaster, think about this fact. What are the chances that everyone gets sick at the same time? Everyone passes away at the same time.
All right, that's true. Even with a natural disaster, most companies don't go bankrupt. Instead, they usually just pull out or no longer renew the policy.
Exactly.
Another question that our viewers and clients have asked is, what about the companies that offer pensions that collapsed, like the Lehman Brothers or Enron?
Yeah, we get that asked a lot. But if you look closely, those with a 401k lost most, if not all, of their 401k. However, according to the Times.com, Lexology.com, and many other articles, they all show how the Lehman Brothers former employees with a pension were still paid in full or honored. The same was true for many Enron former employees as well.
That's true. Now, are pensions going away? Yes. That started in the 1980s when 401ks were created. However, those who already retired and received a pension still have it to this day. And a good example is IBM.
Yeah, as a matter of fact, many of our IBM former employees still have their pensions today. But all of their colleagues that are still working, they had their pensions converted to a 401k. So they no longer have a pension.
Right. Imagine if all the government and union workers today lost their pensions in retirement.
Exactly. How many teachers, union workers, government retirees would be on the streets homeless? Imagine the catastrophe. Most of their retirement is funded through their pension. They don't retire with a huge 403b or IRA or 401k. The average person that has a nice pension usually only retires with, say, a couple $100,000 in their retirement.
Right. Kai, can you explain to the viewers the difference between a traditional pension and a hybrid pension and how that can help them feel more confident with insurance companies?
Sure. A pension is like this paper. You cannot cash out or change your mind. There's no growth and there's no cash value. Why? Because you have no asset. Now, majority of pensions, you cannot even leave your money to your beneficiaries. However, you do have this lifetime guaranteed income. Similarly, a hybrid pension, you still have the guaranteed income for life, like a traditional pension. Now, here are the key differences.
Let's use my purse as your cash value, your asset. You can cash out and grow your cash or pass the remaining cash to your beneficiaries as legacy. The fact that you can change your mind and cash out should give you the peace of mind to know that you can have access to your money in case you feel like your insurance company is not doing well. Yes, to all those tuning in, remember the points we discussed above. It's very unlikely that the insurance companies will collapse overnight like the banks. But even with that, if you feel uncomfortable or are not happy with the insurance company, you can always cash out.
And if you live a long life and you use up all of the cash, you will still have this guaranteed lifetime income.
And that's why we feel very confident putting half of our assets into a hybrid pension. Who doesn't want to have a guaranteed lifetime income or replace 100% of their salary in retirement?
Remember, never once in the last 30 to 40 working years Has anyone accepted a job that pays them solely based on their some kind of investment portfolio?
Right. Maybe as a yearly bonus, but definitely not their main salary.
And that's how people have planned or are planning the next 30 to 40 years of their retirement hand.
But that's all they know, and that's all they've been taught.
And that's what gets me all riled up. We're blinded by the lack of transparency from Wall Street and advisors who are holding our money. And if I were to ask you, would you come and work for us if your income is based solely on the stock market with no guaranteed salary? Just, hey, watch the market. And if the market is up, great, you have a nice fat paycheck. If the market is down, sorry, I can't pay you.
No, that's redonkulous, as my daughter would say.
That means ridiculous. What do you mean, your daughter?
My daughter.
It's our daughter.
My money.
But no, that's another video. If you guys watch, whatever. Anyway, so why should the next 30 to 40 years of your retirement be dependent on the stock market? With no guaranteed income other than a small Social Security check that barely pays for your morning coffee.
Yeah, and I need my coffee.
I do too. The reason why many people feel more confident in retirement with a pension is because a pension is a guaranteed lifetime income, not an investment. Understanding that a pension is not an investment will also help you to not worry too much about insolvency.
Now, you said a pension is not an investment. Do you want to clarify that?
Sure. To be clear, many pensions while you're working are in some type of investment similar to a 401k. However, when the employees retire and they start collecting the pension is no longer in the form of an investment.
Right. It's an insurance policy.
That's right. As a matter of fact, all pensions are annuities. Yes, all pensions are annuities. You see, insurance is based on actuaries and statistics, not investments. Pensions or hybrid pensions are already calculated with a formula that includes your age, life expectancy, mortality, years vested, and so forth.
Wait, I'm sure many viewers are thinking that they heard annuities are bad and to stay away from them.
And remember when we were doing seminars and we would ask people to raise their hands if they wish they had a pension?
Yes, and everyone's hands would go up.
But then we asked how many people wish they had an annuity? What happened?
Right. I mean, I remember every seminar we did, hardly any hands would, or no hands would go up. But when we asked how many of us here stay away from annuities, then that's when all the hands would go back up.
See, that's the problem. So many people are misinformed or confused regarding the word annuity. They don't even know the different types. Most people think a pension, a hybrid pension, or annuities are some type of investment. As mentioned in our other videos, your investments have the ability to lose value, while only variable annuities can lose value. And we don't recommend them anyway. Not only because they can lose their value, but also because their fees are typically 2 to 4% per year.
There's a video you can all watch if you would like to learn 5 different types of annuities and which ones to stay away from. And we'll show you that in a bit.
You know, and the fear of insolvency is really not the biggest concern. The number one biggest concern for retirees right now is the fear of outliving their money.
Yes. Many people are living longer, and for 90% of retirees, Social Security is their only source of guaranteed income.
And most don't realize that there are only 3 sources of guaranteed income in every country: a traditional pension, a government pension like Social Security, or a hybrid pension. Of the 3, we personally prefer the hybrid pension as it gives us control over our money in the event that anything does happen to that company.
Yeah. It's surprising how most people that talk to us said they've never learned about any of this or even heard about hybrid pensions.
Well, the reason for such a lack of understanding and confusion around all of this topic is that broker-dealers cannot charge a management fee. No financial advisor can charge a management fee on guaranteed income except for variable annuities, which many people don't like anyway.
Well, are there any other questions you would like us to answer? Please call us or put it in the comments below. And by the way, here's the video we mentioned earlier to learn all 5 types of annuities and which ones to stay away from.
Meanwhile, please help us grow our channel by hitting that like button. This and your comments allow the YouTube robots to show that this video is worth informing other people regarding this topic.
Until next time, keep a lookout for our other videos to help you retire healthy and wealthy.